Discover which records HMRC expects for gifts out of surplus income in 2026-27 and how proper evidence can help support inheritance tax planning.
You have spent 30 years building a profitable UK company, accumulating significant wealth, and trusting that your estate is protected from inheritance tax. At Pro Tax Accountant, we guide successful company directors through the complexities of UK corporate and personal tax compliance. Right now, that means addressing a severe threat to your family's future wealth. From April 2026, the government is capping 100% business property relief and agricultural property relief at a combined £2.5 million. Anything above that threshold now faces a tapered 50% relief, pulling vast amounts of previously sheltered business wealth directly into the tax net. Following closely behind that, the April 2027 legislation will bring unused pension funds, long considered the ultimate safe harbor, straight into the value of your taxable estate. This chart shows exactly where these policies lead. UK inheritance tax receipts climbing rapidly to a record £7.5 billion. With the standard nil rate ban firmly frozen at £325,000 until at least 2030, fiscal drag is doing exactly what it was designed to do. Traditional estate tax shelters are collapsing. Without immediate defensive action, business owners are exposed to a 40% reduction on their life's work. The most effective defense strategy remaining in the tax code is Section 21 of the Inheritance Tax Act 1984, commonly known as the Normal Expenditure Out of Income exemption. Section 21 allows you to make regular gifts from your surplus income that are immediately exempt from inheritance tax. There is no financial cap, and it completely bypasses the standard 7-year survival rule. Yet, despite being the most powerful tax shield available, high net worth taxpayers are consistently losing their claims when challenged by HMRC. Cautionary tone. Many company directors encounter a specific trap when reviewing their tax position. They realize their so-called surplus has legally morphed into capital. HMRC does not assess your intentions. They assess your paperwork. The audit process is ruthlessly evidence-based, testing documentation over intent every single time. Relying on a vague notion of habitual generosity without strict mechanical proof is a dangerous myth. When that myth shatters under HMRC scrutiny, it costs a family 40% of their gifted wealth. This diagram illustrates 3 strict conditions HMRC requires for the exemption. They form an interdependent framework. Gifts must follow a normal pattern, be funded strictly from income, and leave your standard of living intact. The first requirement is a settled, documented pattern of expenditure. The reality of how this condition is enforced was made exceptionally clear in the 2026 First-Tier Tribunal case of Jeremy John Hosking. Mr. Hosking had vast surplus income and over 7 years gave away £47.5 million. Despite this massive wealth, HMRC successfully assessed a £349,309 inheritance tax bill. The challenged transfers were political donations made to campaign groups supporting the UK leaving the European Union. The tribunal dismissed his appeal because the donations fluctuated based on the campaign's immediate needs and his available cash. There was no formal amount given, and no predictable, settled pattern. HMRC does not care about the sheer scale of your wealth. They demand a documented, mechanical habit of giving. Spontaneous largesse fails the audit. The second condition states that gifts must be funded strictly from income, not from capital. Acceptable after-tax income includes your salary, regular dividends, rental yields, and pension withdrawals. This timeline demonstrates a critical piece of case law, the 2-year rule. Income does not retain its status indefinitely. If you leave a large dividend payout untouched in a personal account for over 2 years, HMRC legally reclassifies that money as capital. The same strict classification applies to investment bonds. The standard 5% withdrawals are legally considered returns of capital. You cannot use them to claim an income exemption. Professional tip. Maintaining proper records is essential for HMRC compliance. The burden of proving the source of these funds falls entirely on your executors after you are gone. If your executors mistakenly report gifts made from aged capital as gifts from income on the tax returns, they can be held personally liable for the resulting tax errors. Failing to meticulously trace the source of funds and accidentally gifting aged capital instantly invalidates the tax shield. Finally, the donor must retain enough income to maintain their usual standard of living. Consider an SME owner who commits to gifting £50,000 annually from their company dividends. Midway through the year, they face unexpected private care costs or take an expensive holiday and must draw down their savings to pay for it. The strict rule applies. If a donor dips into their capital to fund their normal lifestyle because they gave their income away, the gift fails the test. This formula breaks down the mathematical penalty. That failed £50,000 gift is immediately reclassified as a potentially exempt transfer. If the donor dies within 7 years, a 40% tax is applied, creating a £20,000 inheritance tax bill. HMRC Form IHT 403 is the official battleground where this math is scrutinized. This document requires a rigorous year-by-year breakdown of your income and regular expenditure. True surplus income is not a subjective feeling of wealth. It is a rigid, mathematical calculation that must balance perfectly on this form. Reconstructing this picture from scratch years after a death is a nightmare for executors. The only way to guarantee the exemption is to build your case while you are alive. Step 1 of the Pro Tax Accountant Blueprint. Draft and sign a formal letter of intent before the first transfer. This establishes the mechanical commitment to a regular pattern of giving. Step 2. Maintain a dedicated annual gifting diary. Every entry must link a specific income source directly to a specific outgoing gift, proving the funds are fresh income. Step 3. Complete the IHT 403 surplus schedule contemporaneously at the end of every single tax year, treating it as a living document rather than a posthumous chore. The immense tax-saving power of Section 21 is entirely dependent on executing this administrative compliance in real time. As the nil rate bands remain frozen and asset values climb, fiscal drag will consume a larger portion of your estate. You need to lock in your surplus income strategy now. To structure a fully compliant gifting plan ahead of the April 2026 and 2027 deadlines, contact Pro Tax Accountant today. Call us on 07985 689 912, email info@protaxaccountant.co.uk, or visit www.protaxaccountant.co.uk. And please subscribe to our channel for more technical tax updates. Please note, this video is for educational purposes regarding the 2026 and 2027 tax rules and does not constitute formal financial advice. The tax landscape is tightening rapidly, but with proactive, expert execution, you can successfully shield your life's work from a 40%